Lenders are about to fail as demand dries up. I'm your host, Steven Van Metre, and thanks for joining me today. And taking a page straight out of the Great Financial Crisis playbook, lenders are losing money, facing mass layoffs, and on the edge of failure. I want you to understand where this story starts and just how bad it is for many of these lenders. Let's kick the story off where mortgage demand slides further, even as interest rates pull back slightly. Mortgage rates turned lower for the second straight week, but it wasn't enough to boost demand for either new purchase loans or refinances, according to a weekly report from the Mortgage Bankers Association. Applications to refinance a home dropped 2% for the week and were 75% lower than the same week 1 year ago. And most refinance borrowers continue to remain on the sidelines as a result, and refinance applications have fallen 9 out of the past 10 weeks compared to January 2022. Refinance activity is down 66%. Home buyers are also pulling back as applications for a mortgage to purchase a home were flat week to week and down 16% a year ago. And where this matters is the mortgage refinance index. And I want to look at this as something we look at every week. And you'll see the numbers currently at 794. This is where the index is at. Its low point back here in around 2019 or so was around 723. So this index is nearly at its low. And a lot of people believe that rates must continue to rise. And one thing we talk about is that higher rates are actually a problem if people don't want to borrow. So if you're a lender and your product is lending and rates rise, well, investors think, well, that's great. You're going to make a lot more money when you do loans. But if people don't want to borrow at those higher rates, well, it doesn't matter, and that's why you see rates come down. Now, let's take a look at this again because I've got some points here marked. We can go back to, say, 2008, 2014, piece here at 2015, around 2016, 2019, and look what we see here in yields. Everyone has this belief that rates have to rise, but note here in 2008, as applications crashed, rates fell. You see here in 2014, applications crashed, we're at a low, rates were headed lower. Happened again in late 2015. You see applications bottoming out, rates fell. See it again here in 2016, rates went down a little bit in 2019, and guess what? They did and went down again. Now, we're facing the same scenario where rates are headed lower. But this is a huge problem right now for mortgage lenders, because they're losing money and on the edge of failure. Let's check this story out from the Wall Street Journal. As rising rates are battering mortgage lenders, as non-bank lenders in particular are laying off staff, selling servicing rights, and otherwise just trying to survive. Mortgage lenders are scrambling to survive a sharp drop-off in the number of homeowners refinancing their loans, with demand drying up as interest rates rise, just as we talked about. And mortgage giants, including Wells Fargo and Rocket, have trimmed staff this spring, and we covered that back this spring as well. Online lender Better.com has laid off or offered buyouts to about half of its workforce since last December. And while home prices continue to rise and Americans are still buying houses, the drop-off in refinance activity is a giant blow because refinancing made up a bulk of U.S. mortgage originations throughout the pandemic. And this is something I want you to think about when people say, how do you know that rates are going to go down even lower than they were before? Because if you think about it, if everyone refinanced majority of their loans back near the pandemic lows, well, how far do rates have to go to get those people to refinance again? They have to go lower. And that's why we see every time where there's a backup in rates, a drop in demand, rates eventually make new all-time lows. Let's continue on, because some lenders are considering selling themselves, convinced it's the only way to make it through, according to industry executives and advisors. Many lenders are losing money and have the prospect of losing money for the foreseeable future. Of course, when you can't sell your product because people don't want to buy it, that's going to happen. And partnering up could be a strategic alternative, as we may see a lot of mergers coming. You saw lenders panic a bit with the decline in originations, as the mortgage market slowdown is just another consequence of the Federal Reserve's attempt to curb red-hot inflation. And we talked about how the Fed wants housing prices to come down. This is something they want to happen. They want to slow the economy down, and that includes the housing market. But lenders are going to take a brunt of this, and you'll see this is where a lot of the unemployment claims are going to start with as lenders lay off. The Fed has raised interest rates twice this year, trying to cool the economy as India's largest mortgage bond buying program this spring. In fact, it's actually in less than a week now, I think about 4 trading days, the Fed's going to start quantitative tightening, and part of that is they're going to unwind their mortgage part of their balance sheet, those mortgage loans. And those mortgage loans have been credited with keeping rates low. So if the Fed is going to reverse that, be interesting to see if actually rates for mortgages rise as other rates fall due to declining demand. So it'd be really interesting to see how this plays out. And that has pushed up borrowing costs for mortgages, drying up the pandemic refinancing boom, and even shoving some would-be homebuyers out of the market. Originations at the 50 largest lenders fell 41% in the first quarter from a year earlier, and that is huge. Mortgage volume is expected to fall 37% this year, if you can imagine. And could it get worse? Well, yes. The housing market still looks hot by historical standards, and home prices are still rising. But the Fed's move have raised questions about whether the U.S. is headed toward a recession, which would likely slow home sales and make it difficult for some homeowners to keep up with their monthly payments. And April's seasonally adjusted annual rate of home sales was the lowest since June 2020. So again, if you think things are bad now, what happens if the Fed drives us into a recession and actually causes, say, housing prices to crash and even more layoffs? It's going to get even worse, much worse. And the pain is expected to be especially bad for non-bank mortgage lenders. Unlike banks, they don't have numerous business lines to carry them through mortgage downturns. They also don't take deposits, which means they are reliant on short-term loans. 7 of the 10 largest refinancers in 2021 were non-banks. So you can imagine where this next crisis is going to be at is with these non-bank lenders. That could be interesting. A few non-banks were big names, such as Rocket, which is now the biggest mortgage lender in the U.S., but there are thousands of smaller lenders scattered throughout the country. They are often the preferred route for home ownership in moderate-income families or first-time homebuyers, as non-banks issued about 70% of U.S. mortgages last year, the highest share on record. It's common for lenders to lay off workers, as I've said, when interest rates rise, just like they did in 2018. In fact, they've done it every time in the past when rates rise, and then hire them right back again when rates fall. However, the run-up to 2008, mortgage companies instead lowered lending standards to keep volume high, laying the seeds for a global financial crisis. This time, they've kept their standards relatively strict, and they're unlikely to ease them because they really don't have the latitude. As the economy slows down, lenders are not going to suddenly say, hey, you know what? We want to lend you a whole bunch of money with the uncertainty of you being able to maintain your employment. And if you're concerned at all about what a real estate crisis could mean to your portfolio, well, you shouldn't be. Put a link up here to Portfolio Shield and in the description below where it's hedging with bonds, because it actually understands that when rates go down, bond prices go up, and that happens because lending demand dries up. But here's how the housing market now is going to get even worse, and we're just seeing the beginning of where this could go. As new home sales in April see the biggest monthly drop since 2013, as sales fell a whopping 16.6% last month, as rising mortgage rates make home ownership more expensive. The entry-level consumer, which is the largest buyer group, is moving to the sidelines as new home sales, which make up more than 10% of all U.S. home sales, are tracked when contracts are signed. Now, I want you to understand what that means. Is if you go out to a new home tract and you say, I'd like to buy a home, and you sign the paperwork and give them a deposit, that is counted as a new home sale. And now, even though you haven't moved into the home may not even be built, you don't have a loan for it, a new home sale is recorded. And that's why these are volatile, because people can back out of those. Of course, the next step when people do that is they go see a mortgage lender and then do what? Open a mortgage application. You've got it. While existing home sales are tracked when the contracts close, that makes new home sales a leading indicator of where market is headed, and I'm very certain it's going to continue, said John Burns, the CEO of John Burns Real Estate Consulting, referring to the declining number of new home sales. And builders have helped shoppers lock in mortgage interest rates in recent months, but their wait list of prospective buyers has been shrinking. And Mr. Burns said he expects new home prices to decline in areas with ample new home supply, particularly in Texas. And once builders have a lot of finished unsold homes, and probably before then, they're going to start discounting, as we talked about in shows this week, where supply is starting to exceed demand, and now it's finding its way into the housing market. Existing home sales fell in April to the lowest level since the start of the pandemic, as they declined 2.4% compared with March, to a seasonally adjusted rate of 5.61 million units. So we're seeing declines in existing home, and sales were 5.9% lower than in April 2021, the slowest rate, if you can imagine, since June of 2020, which is artificially slow because the economy is struggling with sweeping shutdowns. This count represents closing during the month, so it reflects contracts likely signed in February and March when mortgage rates were rising, and they actually still went up from then, indicating that this number could get even worse in the next couple of months. The number of households interested in becoming homeowners remains high despite waning confidence that now is a good time to buy. This is especially true among younger home shoppers who are likely to be first-time buyers and are struggling to save for a down payment as rents continue to hit records. At the same time, seller expectations for higher down payments seem to be rising, fueled by a still competitive housing market and repeat buyers with relatively more equity at their disposal. But with the stock market coming down, those who were using that as part of their down payment or to post a collateral against their mortgage, well, they're going to find out that they're going to end up not being buyers as well. And this is a point where the Fed is getting ready to ratchet things up. And here again, in less than a week, quantitative tightening starts. In less than 3 weeks, we're supposed to get a 50 basis point rate hike. And here you can see the Fed rate hike paused in September may make sense, according to Bostic, as the Atlanta Fed leader supports half-point hikes through June and July. I want you to understand, he's referring to another 1% increase this summer of the federal funds rate, and nothing is off the table, he claims. I've got a baseline view for me of where I think a pause in September might make sense, and after we get through the summer and we think about where we are in terms of policy, I think a lot of it will depend on on-the-ground dynamics that we're starting to see. My motto, observe and adapt. And what he's trying to tell you here is that monetary policy works with a lag. And what we're seeing maybe with the stock market going down is likely not much to do with monetary policy and more to do with a lack of fiscal stimulus. Because if you remember, who's been the marginal buyer of stocks that is not concerned about price? It's been people who got their fiscal stimulus checks and turned around and bought stocks. Monetary policy works with a lag. He knows it. And that's why he's saying that, hey, let's go do 2 more hikes here and then take a pause and see where the data is going, because so far, the data is not showing any pause, and that means more tightening. I'm at 50 basis points as long as the economy proceeds, and I think it's going to. If inflation starts moving in a different direction than it is right now, I'd have to be open to us moving more aggressively. I do want to make it clear that nothing is off the table, and as we go through the months, we'll see how it plays out. He said he's forecasting inflation to likely be high 3% at the year's end, which would be really impressive with a lot of uncertainty around forecasts. He expects economic growth to be above trend this year. So what he's saying is, look, if you're planning on us scaling back or easing, it's not going to happen. We're going to not only tighten, but we don't even think we're going to get to our target by year end. And a lot of the stock investors are betting on just the opposite. Recent financial market moves, including a sharp decline in stocks last week, were consistent with the Fed's goal for financial tightening, Bostic said. So I want you to tell him, he's telling you right now, we expect stocks to go down and we're A-okay with it. And as we continue to tighten, guess what? They're going to go down even more. But there have been a few signs on the real side of the economy that indicate slowing since the Fed commenced rate increases in March. Bostic told his Rotary Club luncheon audience that the Fed's goal was a soft landing. We'll give him good luck to that, bringing inflation down to 2% and slowing the labor market to a more normal functioning. Adding will require dexterity to achieve. And with that, now you can see why, thanks to the Fed, a slowing real estate market, the lenders are likely to fail. And that's really a big problem because new money in our financial system is created when people borrow. And if people aren't borrowing and lenders fail, well, that means we're headed to a recession. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.